Today, we're plunging into, well, a really interesting story. SEACOR Marine Holdings Inc. You might picture this company, quietly being the workhorse of global energy for decades, powering those massive offshore oil rigs.
That's the traditional view, definitely.
Okay, but what's fascinating is they're also making this significant, almost silent pivot towards offshore wind. It's like they're walking a tightrope between old energy and the new frontier.
It really is. And that's our mission today. A detailed financial analysis of SEACOR Marine Holdings Inc., ticker symbol SMHI.
Right.
We're going to unpack its operations, really dig into its financial health, look at the strategic moves they've been making, and of course, explore the significant risks it faces.
Exactly. And it's important to stress where we're getting this info. Our entire analysis is grounded purely in factual data pulled directly from SEACOR Marine's own public filings. Specifically, we've sifted through their annual 10K reports, the ones filed with the U.S. Securities and Exchange Commission, covering financial years right up to December 31st, 2023.
So it's straight from the horse's mouth, so to speak, based entirely on their own reporting.
Precisely. Which leads us to a really crucial disclaimer.
Yes, absolutely vital.
We cannot stress this enough. This financial analysis is strictly for informational and educational purposes.
That's right.
It is not in any way, shape, or form financial advice. You should not base any investment decisions on what you hear today.
Please don't. We strongly, strongly urge you to conduct your own thorough research and critically consult with a qualified financial advisor before making any investment choices.
Yeah, this is about understanding the company, the mechanics, the numbers. It's not an endorsement or a recommendation to invest.
Couldn't agree more.
Okay. With that important caveat out of the way, let's really get into what SEACOR Marine actually does. SEACOR Marine Holdings Inc., SMHI, the operational landscape. So what is SEACOR Marine's bread and butter out there on the high seas? They've been around a while, but their focus seems to be shifting.
Well, what's really interesting, as you mentioned, is their dual energy focus. For years, yes, primarily supporting offshore oil and natural gas facilities worldwide. That's been the core.
The legacy business.
Exactly. But increasingly, they're getting involved with offshore wind farm installations and maintenance.
Okay.
And this isn't just, dabbling. It feels like a critical strategic bet.
Yeah.
They're trying to position themselves to be essential, whether the world sticks with oil and gas longer or pivots hard to renewables.
It's a tricky balance.
It is a challenging tightrope walk, definitely, but potentially key to their long-term survival in this, very dynamic energy market.
So that must mean their fleet is incredibly interesting, pretty specialized and diverse to handle both sides of that coin, right?
Absolutely. They have a whole range of vessels, and each type has a very specific, critical role.
Like what?
Well, for offshore wind farms, for instance, they use crew transfer vessels, or CTVs. You might hear them called Windcat series vessels.
Okay, CTVs. What makes them special?
They often have a catamaran hull, gives them stability, and a flush foredeck. That design provides a remarkably stable platform, essential for safely hopping personnel and supplies onto wind turbines, especially when the sea is a bit rough.
Right, safety first.
And they're pretty quick too, speeds between 25 and 31 knots. That efficiency matters, especially somewhere like the North Sea where a lot of this activity happens.
So fast, stable, key for the wind sector. What about the more traditional oil and gas side, their routes?
Well, there you have the anchor handling towing supply vessels, or AHTS vessels. These are the real powerhouses.
Anchor handlers, got it.
They're critical for offshore drilling. Think towing, positioning, mooring those enormous drilling rigs. Imagine the force needed to pull a rig. They also ferry supplies from shore bases out to the installations. And they carry and launch remote-operated vehicles, ROVs, for all sorts of underwater work, like, installations, maintenance, repairs.
So they're versatile workhorses. How are they measured? Like, what defines them?
Key things are horsepower, BHP, bollard pull, that's their pulling capacity, crucial for towing winch size, and how much wire they can store.
Okay.
And what's important technically, as of the end of 2019, all 8 of their owned and leased-in AHTS vessels had DP2 systems.
DP2, explain that.
Think of it like a super advanced GPS-linked autopilot. It uses multiple thrusters to hold the vessel perfectly still, even in rough seas or strong currents. Absolutely vital for precise jobs like mooring a rig or delicate underwater ROV work.
Wow, so that allows them to work in deep water.
Exactly. Their HTS fleet supports operations in water depths from, say, 300 feet down to 8,000 feet. Deep water capability is essential these days.
Definitely. What other major vessel types do they rely on?
Then you have the platform supply vessels, PSVs, generally bigger vessels, maybe 190 to over 300 feet long.
Okay, PSVs and their job.
Primarily delivering cargo to rigs and platforms where drilling or workover is happening. Things like drilling fluids, bulk products, methanol, diesel fuel, water, all the essentials.
Just supplies then.
Mostly, but they're actually quite adaptable. You can fit them with a crane for construction support. They can serve as standby or security vessels, help with firefighting, even provide accommodation for extra crew offshore.
Multi-purpose.
Very much so. The key specs for PSVs are things like total carrying capacity, that's deadweight tons, or DWOT, how much clear deck space they have for equipment, their below deck capacity for liquids and bulk stuff, fuel efficiency, and operating draft.
And any tech upgrades there, like the DP2 on the anchor handlers?
Yes, DP2 is common on the PSVs too. As of the end of 2021, all 20 of their own PSVs and 11 of their 15 joint ventured ones were DP2 equipped.
Okay.
And interestingly, showing that push for efficiency or maybe sustainability, 6 owned PSVs and 3 joint ventured ones had hybrid power systems installed by that date.
Hybrid power on massive offshore vessels. That's interesting.
It is. Shows they're looking at efficiency and emissions where they can, even on these large workhorses.
So they're not just moving stuff, but trying to be smarter about it. Any other vessel types we should mention?
Yeah, they also mentioned fast supply vessels, or FSVs. These seem to be more general utility for quick transfers, useful to a broad range of customers.
Okay.
And then there are lift boats. These are quite specialized. They can actually jack themselves up out of the water on legs, creating a stable platform right next to a structure.
Like a mobile work platform.
Exactly. Really useful for certain offshore maintenance and construction jobs where you need a steady base elevated above the waves.
So it's clear the fleet is central, but it's not just about chartering these boats out, is it? They do other things too.
That's absolutely right. Beyond just hiring out their vessels, SEACOR Marine offers quite comprehensive management services.
The management, like
Right.
managing ships for other owners.
Precisely. They act as agents, offering the whole package. Crew management, technical and commercial management, sorting out insurance, helping with vessel sales or purchases, arranging provisions, bunkering fuel.
For a full service package.
Yeah. And these agreements usually run for 1 to 3 years, billed monthly. That provides a nice, steady, recurring revenue stream for them, separate from the charter market volatility.
That makes sense. Diversifies their income.
It does. And on top of that, they offer engineering services. Leveraging their expertise for vessel construction and conversions shows they have deep knowledge across the marine sector, not just operating vessels.
Fascinating how integrated they are. Okay, let's zoom out. Where are all these vessels actually working? What's their global footprint look like now, or at least as of the end of 2023?
Their reach is properly global, and these vessels are highly mobile. They move between regions pretty routinely, depending on where the work is, market demand, and of course, flag restrictions.
So where are the main hubs?
Key operating regions include the United States, primarily the crucial Gulf of Mexico, then Africa and Europe. The Middle East and Asia is another big one, supporting activities in places like Egypt, Israel, Malaysia, the Arabian Gulf, Arabian Sea, including Saudi Arabia, UAE, Qatar.
Busy area.
Definitely. And Latin America, too, mainly Mexico, Brazil, and Guyana, but also touching Trinidad and Tobago, Colombia.
So they're truly spread out. That gives them flexibility, but also exposes them to different regional issues, I guess.
Exactly. They can shift assets to chase the stronger markets. But yeah, it means they're dealing with a whole basket of diverse regional risks and regulations.
What about actual fleet size? How many vessels were they operating as of end 2023?
As of December 31st, 2023, the company operated a diverse fleet of 58 support vessels in total.
And are those all theirs?
Not quite. 55 of those were either owned outright or leased in under long-term agreements. The other 3 were vessels they managed on behalf of unaffiliated third parties, tying back to those management services we talked about.
Gotcha. And how has that fleet mix changed over time? I seem to recall some sales strategic shifts, maybe.
Yeah, there's been evolution. If you look back at their own fleet in 2022, for example, it was 21 PSVs, 22 FSVs, 9 lift boats, and 3 AHTS vessels. That totaled 55 owned vessels then.
And the age. That's always a factor.
The average age of that 2022 owned fleet was about 9 years. Pretty reasonable for this industry. And it was split between 17 U.S. flagged vessels and 38 foreign flagged.
And the changes. Vessels being removed.
Right. They've been actively managing the fleet. For instance, they noted 4 lift boats were removed from service back in 2021, and 1 specialty vessel was taken out in 2022. This isn't just wear and tear, it suggests strategic pruning, getting rid of older or less profitable assets.
Making tough calls to stay efficient.
It seems so. Shedding assets where the market demand or profitability just isn't there anymore to focus resources elsewhere.
And what about those bigger strategic divestitures, the discontinued operations you see in the reports? Those sound like major shifts.
They were. There are a couple of key examples. They sold off their North Sea standby safety fleet. Those are ERRVs, emergency response, and rescue vessels back in December 2019.
Okay, streamlining there.
And then, in January 2021, they completed the sale of Windcat workboats. That was the business focused on those crew transfer vessels for offshore wind we discussed earlier.
Huh. Selling the wind business seems counterintuitive given the dual focus idea.
It does on the surface, but both the ERV fleet and Windcat were classified as discontinued operations. This signals a strategic decision to exit those specific lines of business, perhaps because they weren't hitting profitability targets or they wanted to refocus capital elsewhere. It allows them to concentrate management attention on what they see as their core ongoing operations.
Interesting. So quite a bit of restructuring and refocusing. Okay, moving on to their customers. Who are they actually serving with all these vessels and services?
It's a pretty diverse clientele list. You've got the major integrated oil companies, the big household names, both national and international, independent oil and gas exploration and production companies too. Oil field service and construction companies are also key customers.
And the wind farm operators?
And importantly, yes, the offshore wind farm operators, tying back to that dual focus.
But is there a risk of relying too heavily on just a few big players? Customer concentration.
That's a really important point.
Yeah.
Yes, there is notable customer concentration risk. It was particularly evident in their 2022 numbers.
How so?
That year, just 2 customers accounted for over 10% of their consolidated operating revenues each. ExxonMobil was a big one at 18%.
Wow. 18% from one customer.
And SEACOR Marine Arabia LLC, that's a 45% owned joint venture they have, primarily serving Saudi Aramco, accounted for another 14%.
Okay, so those two are over 30% combined.
Exactly. And if you look at their top 10 largest customers together, they accounted for roughly 63% of consolidated revenues in 2022.
63%. That sounds high.
It is quite concentrated. It means the loss, or even a significant reduction in business from one or more of these major clients could really hit their financial position and results hard. They're quite vulnerable to shifts in these key relationships.
I can see that. It's great to have big contracts, but yeah, losing one would sting. Are they trying to diversify that?
I imagine they are always trying to broaden their base, but in an industry dominated by such large energy players, achieving true diversification is a constant challenge. It remains a key vulnerability you have to watch.
Definitely. Okay, so how does all this operational activity translate into their costs? Running a global fleet of specialized vessels can't be cheap. High fixed costs, I'm guessing.
You've hit the nail on the head. This industry is characterized by very high fixed costs. Think about it, crew salaries, basic maintenance, insurance, shore-based support. A lot of that cost is there, whether a vessel is working flat out or tied up at the dock.
Like running a hotel. Gotta pay staff, even if rooms are empty.
Exactly. It means their operating margins are incredibly sensitive to changes in 2 key things: the rates they get per day worked and their fleet utilization. What percentage of the time the vessels are actually earning revenue.
So if rates drop or utilization dips, those fixed costs just eat away at profits.
Precisely. And there's very little reduction in the daily running costs for a vessel unless they take the drastic step of cold stacking it.
Cold stacking, what's that involve?
That means basically mothballing the vessel, pulling most of the crew off, shutting down systems, anchoring it somewhere safe long term. It saves significant money on daily running costs.
Oh.
But reactivating a cold stacked vessel is a very expensive and time-consuming process. You have to inspect everything, do repairs, recertify systems, recrew it. It's a big decision, usually signaling that management doesn't expect demand for that vessel type to return anytime soon. 2, deeper dive into operational and financial performance.
Okay, that paints a clear picture of the operational setup and those challenging high fixed costs. Let's dive deeper now into their actual operational and financial performance. First up, revenue drivers and market volatility. You mentioned oil and gas prices earlier. That seems like a huge factor and notoriously unstable, right?
Absolutely fundamental. Their business, especially the traditional side, really lives and dies by the spending decisions of oil and gas companies. How much are they investing in exploration, development, production, maintenance, decommissioning? That's the key driver.
And that spending is directly tied to commodity prices.
Directly. We've seen incredible volatility historically. Oil prices peaked over $100 a barrel in 2014, then crashed to around $26 in early 2016, near a 10-year low before recovering somewhat.
Wild swings.
Exactly. And when prices fall sharply, often because there's just too much supply sloshing around compared to demand, what do the oil companies do? They slash their capital spending, especially on expensive offshore projects.
Which means less work for companies like SEACOR Marine.
Precisely. It reduces demand for their services and puts immense downward pressure on the charter rates they can command. It's a direct hit to their top line.
That makes sense. So how does this volatility show up in their fleet utilization numbers? Do the vessels just sit idle when the market tanks?
That's exactly what happens. The fleet utilization trends clearly reflect this market sensitivity. If you look historically, overall fleet utilization improved from 50% back in 2017 up to 67% in 2019, and then jumped further to 77% overall in 2021 as markets perhaps started to recover.
So an upward trend recently, but is it consistent across the board?
Not really. There's significant regional variation, which is interesting. For example, looking at 2020 data, utilization in the U.S. Gulf of Mexico was incredibly low, just 7% for some segments maybe.
7%, basically parked.
Yeah. While at the same time, Latin America was running hot at 92% utilization. It really highlights how different regional dynamics and specific long-term contracts can affect parts of their fleet very differently.
And by vessel type, any standouts?
In 2021, for example, lift boats showed almost 100% utilization, reflecting strong demand for their specialized capabilities. But the AHTS vessels, the anchor handlers, were at a much more challenging 56%. So it's a real mixed bag depending on the market segment and vessel type.
And utilization obviously feeds directly into the rates they can charge. Low demand means low prices, I assume.
Exactly right. The rates per day worked what they call time charter statistics vary hugely by vessel type and region.
Can you give an example?
Sure. In 2021, those high utilization lift boats were averaging over $25,000 per day. But other specialty vessel types might have been earning significantly less, maybe under $2,000 per day in some cases.
Huge difference.
It is. And overall rates per day worked have fluctuated year to year, $10,369 in 2019, up slightly in 2020, down in 2021, back up slightly in 2022. It shows constant market pressure and adjustment.
So even if utilization climbs, if the rates they're getting are weak due to competition or just low overall demand, profitability can still be tough.
Absolutely. You need both utilization and decent rates to make good money, especially with those high fixed costs we talked about.
Got it. Are there seasonal factors here too, like a busy season for offshore work?
Yes, definitely. Operations are subject to seasonality. Demand tends to be stronger historically in the second and third calendar quarters, think spring and summer in the northern hemisphere.
Why then?
It aligns partly with customer budget cycles, but also crucially with more favorable weather windows for offshore activities in key regions.
Makes sense. Less chance of storms disrupting work.
Right. Peak demand for their lift boats in the U.S., Gulf of Mexico and Europe, for offshore support vessels in the Middle East and West Africa, and for those crew transfer vessels in the North Sea typically happens during the summer months.
But seasonality cuts both ways.
It does. It can create unpredictability in activity levels and utilization rates, making forecasting harder. And if something bad happens during that peak season, a hurricane, a major equipment failure, it could have a disproportionately large negative impact on their annual results because they're missing out on prime earning time.
Okay, that sets the market context really well. Let's get into the nitty-gritty of their financial performance now. We're looking at their consolidated income statements for 2021 through 2023. What's the headline on operating revenues?
The headline for operating revenues is actually quite positive, showing a clear upward trend over those 3 years.
Good news then.
Seems like it. Revenues were $170.9 million in 2021, climbed to $217.3 million in 2022, and then jumped again, quote, nicely to $279.5 million in 2023.
That's solid growth. What drove that?
The filings point to a few key drivers for the increase, particularly in 2022. Higher charter revenues were a big piece, partly from repositioning vessels to better markets, partly from acquiring PSVs via the OSV Partners merger, and also from just better overall utilization. Other marine services revenue also increased, helped by things like business interruption insurance proceeds and higher management fees.
So a combination of market recovery, strategic moves, and operational improvements feeding the top line.
It looks that way. Suggests they were capitalizing effectively on improving conditions and their own strategic adjustments.
Okay, top line looks better. What about the direct costs of earning that revenue? How did direct operating expenses trend?
Direct operating expenses showed a bit more fluctuation. They were $127.4 million in 2021, then rose significantly to $172.0 million in 2022.
Following the revenue increase?
Largely, yes.
Yeah.
But then, interestingly, they decreased in 2023 to $159.7 million.
Down in 2023.
The company attributed that decrease primarily to the timing of dry docking and repair spending. Major maintenance cycles don't always fall evenly year to year. Also, the effects of repositioning vessels and net asset dispositions played a role. It suggests they were managing those direct costs carefully alongside their operational shifts.
Right, timing of big maintenance can definitely swing those numbers. Beyond the direct vessel costs, what about the overhead administrative and general expenses? How have those looked?
Administrative in general, or A&G, expenses have generally trended upwards over this period. They went from $37.6 million in 2021 to $40.9 million in 2022, and then up more significantly to $49.2 million in 2023.
Any specific reason for the increase? Restructuring costs, maybe?
Well, it's worth remembering. They had that transformation plan back in 2019-2020 aimed at cutting costs and workforce. That involved restructuring charges in those prior years. But importantly, no restructuring charges were recognized in 2021, suggesting that specific plan was completed. The recent increases might reflect inflation, investment in corporate infrastructure to support growth, or other general cost pressures.
Okay. And then there's depreciation and amortization. With all those vessels, that must always be a big number, right? Non-cash, but still significant.
Absolutely right. D&A is consistently a substantial figure on their income statement, reflecting that huge capital investment in their fleet. It was $57.4 million in 2021, $56.0 million in 2022, and $53.8 million in 2023.
Pretty stable then, slightly declining.
Yeah, fairly stable. It underscores the capital-intensive nature of the business and the long-term depreciation of these expensive assets.
Now, we saw mentions of gains or losses on asset dispositions and impairments. How significant have those been? Do they tell us anything about the market value of their fleet?
These figures have definitely fluctuated, highlighting the dynamic nature of managing their asset base. They reported a significant gain of $20.4 million back in 2021.
A big gain, selling assets above book value.
Seems likely in that case. Then it was a much smaller gain of $1.4 million in 2022, but then another substantial gain of $21.4 million in 2023.
So strong gains in 21 and 23. What about impairments, writing down asset values?
They did recognize some specific impairments in 2022 and 2023, but relatively small amounts for individual vessels or equipment. Notably, they stated no impairments of owned or leased-in vessels in 2021. So when they were selling assets, especially in those years with big gains, it suggests they were often getting prices above their depreciated book value, a positive sign for the underlying market value of their fleet during those periods.
Okay, now for the really critical line item, operating income or loss. This strips out financing costs, taxes, and other non-operating stuff to show how the core business performed. What's the story here?
This is where we see a really dramatic turnaround. It's a crucial indicator. In 2021, they reported an operating loss of $37.1 million.
Okay, a loss.
That actually worsened in 2022 to a larger operating loss of $54 million.
Ah, great.
But then 2023 saw a remarkable swing. They achieved an operating income of $35.5 million.
Wow. From a $54 million loss to a $35 million profit on operations, that's huge.
It's a very significant turnaround into operational profitability. It reflects those improving revenues we saw, maybe getting costs under better control, and likely benefiting from better market conditions finally kicking in. It suggests their core business started generating positive results from its actual day-to-day activities, which is vital.
That's a major inflection point. Okay, below the operating line, there's other income expense net. What gets lumped in there, and how has that category behaved? It seems to have swung wildly, too, from positive to negative.
Yeah, this category captures a whole mix of non-operating financial items, and it has indeed fluctuated significantly. The total was a positive $43.8 million income in 2021.
Positive. What drove that?
We'll get to that. But then it flipped to a negative $16.1 million expense in 2022 and deepened further to a negative $39.6 million expense in 2023.
So dragging down the overall result in the last 2 years, what's in there? Interest expense must be a big part.
Absolutely. Interest expense is a major component, and it has steadily increased from $28.1 million in 2021 up to $37.5 million in 2023.
Rising debt costs, then.
Reflects their overall debt load and likely the impact of rising interest rates globally on their variable rate debt. It's a growing headwind below the operating line.
You mentioned something driving the positive number in 2021. Was that the debt extinguishment gain? That sounded like a one-off.
That's exactly it.
Yeah.
There was a very notable gain on debt extinguishment of approximately $62.0 million reported in 2021.
$62 million.
Yeah, it resulted from the payoff of the Falcon Global USA credit facilities. It was a substantial one-time benefit from some strategic debt management, and it really boosted their reported net income and earnings per share for that specific year.
But one-time gains don't repeat. Did they have anything similar later?
No, in fact, they reported a loss on debt extinguishment of $2.0 million in 2023, indicating a different kind of debt transaction that year, which resulted in a cost.
Okay. What else falls into other income expense?
They also report derivative gains or losses, net. These were small gains in 2021 and 2023, resulting from their hedging activities like interest rate swaps. And then there are foreign currency losses, gains, net. These have bounced around a loss in 2021, a gain in 2022, another loss in 2023, reflecting the volatility of currency markets impacting their international earnings and transactions.
Right. Global operations mean currency risk. They also have stakes in other companies, joint ventures and such. How did their equity and earnings of 50% or less owned companies perform?
The contribution has actually been declining in recent years. It was $15.1 million in 2021, but then dropped to $7.0 million in 2022, and further down to $3.6 million in 2023.
Less contribution from JVs.
Yeah. It could indicate some challenges within those specific joint ventures, maybe lower profitability, or it could reflect some of the divestitures we discussed earlier, like selling their interest in Mexmore as part of those framework agreements. Diminishing contribution from these associated companies.
Okay, so putting all these pieces together, operating income turning positive, but offset by rising interest costs and fluctuating other items. What's the final bottom line? The net loss income attributable to SEACOR Marine Holdings Inc.
The final net result shows significant improvement, but still finished in the red for 2023. The net loss attributable to the company was identical in 2021 and 2022 at $71.6 million each year.
Ouch, consistent losses.
But then in 2023, that net loss narrowed dramatically to $9.3 million.
Still a loss, but way better.
Exactly. A massive improvement from the prior 2 years. It's really important, though, to remember context for 2021. That $71.6 million loss in 2021 actually included $22.9 million in income from discontinued operations, mainly from that Windcat workboat sale gain.
So the loss from continuing operations in 2021 was actually much worse.
Precisely. Which makes the improvement to only a $9.3 million net loss in 2023, driven by that strong operating income turnaround, look even more significant. The trajectory is clearly pointing towards recovery, even if they hadn't quite reached overall net profitability by the end of 2023. 3. Assessing financial health. Balance sheet and cash flow dynamics.
That's a really helpful breakdown of the income statement journey. Now, let's shift focus to assess their underlying financial health using the balance sheet and cash flow statements. Starting with property and equipment, obviously a massive asset category for a marine company like this. What does it tell us?
Property and equipment, their fleet essentially, is the absolute foundation of their business and represents their single largest asset category by far. Looking at their filings, as of December 31st, 2019, for example, the total net book value of their property and equipment was substantial, well over $600 million.
Mostly vessel then.
Predominantly, yes. The value is spread across their diverse fleet types. HTS, PSVs, FSVs, lift boats, CTVs. Fast supply vessels and lift boats represented particularly large chunks of that net book value at that time. It just underscores the incredibly capital-intensive nature of this industry. These are huge long-term investments.
And how long do they expect these assets to last? What's the estimated useful life for depreciation? Must be quite long.
It varies a bit. For crew transfer vessels, they estimate a useful life of 10 years, perhaps reflecting more specialized usage or maybe faster technological obsolescence in that niche.
Okay, 10 years for CTVs. What about the others?
For all their other offshore support vessels, the PSVs, AHTS, FSVs, lift boats, they use an estimated useful life of 20 years.
20 years?
Yeah. These estimates feed directly into those large depreciation expenses we saw in the income statement and really highlight the long-term investment horizon for their core assets.
Okay, makes sense. Now let's talk about the other side of the balance sheet. Debt. How much do they owe, and what does that debt structure look like? Seemed like a complex mix from the income statement discussion.
It is quite complex, and the total amount is significant. As of December 31st, 2022, their total outstanding indebtedness was reported at $363.8 million.
Over $360 million. How is that broken down? Any major facilities?
They have several key debt facilities listed. One major one was the SMHI loan facility. This was a $130 million loan facility taken out by a wholly owned foreign subsidiary back in 2018. It was administered by DNB Bank ASA.
Okay.
It originally matured in 2023 and bore variable interest based on LIBOR. It was used initially to pay off other existing credit lines. It required quarterly principal payments and was guaranteed by the parent company, SEACOR Marine.
And has it been refinanced or changed? LIBOR isn't really used anymore.
Exactly. It was amended multiple times. Notably, the filings mention a 2023 SMHI credit facility that satisfied the original 2018 facility in full. And crucially, it changed the reference rate for one tranche from LIBOR to SOFR, reflecting that market benchmark shift. Adapting the terms like that is key for managing ongoing financing.
Right. You also mentioned convertible notes earlier. What's the story there? How much and what are the terms?
Yes, the convertible senior notes. As of May 2018, there was $125.0 million in principal amount still outstanding after an earlier exchange with Carlyle. These notes carried a 4.25% interest rate and were originally due December 2023, but that maturity got extended by 12 months.
Convertible into stock, you said?
Right. They're convertible into common stock at a specific price, $11.75 per share, or potentially into warrants. That warrant feature is partly to help comply with the Jones Act ownership restrictions we'll discuss later.
Interesting mechanism. Can the company force conversion?
Yes, there's a mandatory conversion feature. If the volume-weighted average price, VWAP, of their stock stays above certain thresholds for a period, they can force the note holders to convert into equity. It's 150% of the conversion price for Carlyle affiliates, 115% for others. It offers a potential way for the company to deleverage by converting debt to equity if the stock performs well.
Okay. Any other significant pieces of debt?
They also had guaranteed notes. As of 2022, these totaled $90.0 million in aggregate principal. They're described as 8.0%, 9.5% senior peak toggle notes due 2026.
PTAC toggle, what does that mean?
PK stands for payment in kind. Toggle means the company has the option, under certain conditions, to pay the interest either in cash or by issuing more notes instead of cash.
Ah, so they can conserve cash, but the debt principal grows.
Exactly. It offers flexibility for cash management, which can be crucial if cash flow is tight, but comes at the cost of increasing the overall debt burden if they choose the PK option frequently.
We touched on that big $62 million gain on debt extinguishment in 2021. Can you just remind us what that was about and why it was so impactful?
Sure. That gain, recognized in June 2021, was related to the payoff of the Falcon Global USA Term Loan Facility and revolver. It seems they were able to settle or refinance this debt for significantly less than its carrying value on their books.
A good deal for them then.
Apparently so.
Yeah.
It provided a substantial one-time boost to the reported net income and earnings per share that year. Really highlights how actively managing their debt structure, not just letting it sit there, can sometimes yield significant financial benefits.
With all this debt, particularly the variable rate parts, how exposed are they to interest rate risk, and what are they doing about it? Hedging.
Interest rate risk is definitely a factor. As of the end of 2021, they reported having $171.8 million of outstanding variable rate debt. That portion is directly exposed to fluctuations in benchmark rates like LIBOR or SOR.
So rising rates would increase their interest payments.
Correct. To mitigate this, the company actively uses interest rate swap agreements. These function as cash flow hedges, effectively fixing the interest rate on portions of that variable rate debt. For example, they mentioned entering into a swap with a $65 million notional value back in October 2018.
So they hedge some, but not all.
Typically not all, no. The filings estimated that for each 1% increase in the applicable LIBOR rate at that time, their annual interest payments on the non-hedged portions of their variable debt would increase by about $1.7 million.
So hedging helps, but they still retain some exposure. Managing that must be ongoing.
Absolutely. It's a constant balancing act, how much to hedge versus retaining exposure or flexibility.
And what about the fine print in those loan agreements, the covenants? Are they meeting their obligations? And what are the consequences if they slip up?
Loan covenants are critical. They're the rules of the road set by the lenders. The 2023 SMFH Credit Facility Guarantee, for example, includes several key financial covenants they must maintain. Things like maintaining minimum cash and cash equivalents, the hire of $20 million, or 7.5% of their net interest-bearing debt, maintaining a minimum equity ratio of 35%, and keeping their maximum debt-to-capitalization ratio at or below 65%.
And are they complying?
As of December 31st, 2023, the company reported they were in compliance with all such financial covenants.
That's good. What happens if they breach one?
That's the significant risk. Failure to comply could allow lenders to declare the debt immediately due and payable acceleration. It could also trigger cross-default clauses in their other debt agreements, meaning a default on one loan could cause defaults on others. That could severely restrict their operations, cut off access to capital, and put them in a very difficult financial position. Monitoring and maintaining compliance is absolutely crucial.
Definitely sounds like it. Okay, that covers the balance sheet structure well. Let's turn to cash flow now. This often tells a different story than net income, showing how money is actually moving. How have their cash flows from operating activities looked, especially given those net losses we discussed?
Cash flow from operations, or CFO, is a really crucial metric, exactly because it strips out non-cash items like depreciation and shows the cash generated by the core business. And here, the story is one of significant recovery.
Better than the net income picture?
Generally, yes, particularly in the later years. After actually using cash in operations back in 2020, they turned positive. They generated $9.0 million in 2021, a similar $8.9 million in 2022, and then a really strong $49.1 million provided by operating activities in 2023.
Wow, nearly $50 million generated from operations in 2023, despite the small net loss.
Correct. It demonstrates a robust recovery in their ability to convert their day-to-day business into actual cash. This is vital for funding operations, servicing debt, and potential investments. It suggests an underlying operational strength even while navigating those non-cash charges or higher interest costs that led to the net loss.
That's a much more positive indicator. What about investing activities? Where has the cash been going or coming from in terms of investments? Fleet expansion, selling things off.
Cash flows from investing activities have also shown considerable movement, sometimes providing cash, sometimes using it. They actually provided significant cash in this category in 2019, 2021, and again in 2023.
Provided cash, meaning more money came in from investing than went out?
Often, yes, driven partly by those asset dispositions of vessel sales we talked about. Looking at the spending side, capital expenditures, CapEx, were quite high back in 2019, $44.8 million, but were significantly reduced by 2021, $7.0 million.
Pulling back on spending then, what about 2023?
For 2023, their expected CapEx was relatively modest, around $1.7 million, notably earmarked for installing that hybrid battery power system on an existing PSV. This aligns with a strategy perhaps focused more on upgrading the existing fleet in efficiency rather than massive new builds during that period.
So less spending on new ships, more on upgrades, and maybe selling older ones. What about proceeds from those sales?
Exactly. Proceeds from dispositions have been a significant source of cash inflow in several years. $55.3 million in 2019, $20.7 million in 2020, $30.1 million in 2021.
Big numbers. What sales were those?
The 2019 figure included $27.4 million from selling that ERV fleet. The 2021 proceeds were significantly boosted by the net cash received from the Windcat workboat sale, about $38.7 million after costs. So divestitures have definitely played a role in their cash management.
And investments in JVs.
They also show outflows for investments in joint ventures, $17.4 million in 2019, and sometimes inflows from returns from investments, like $9.4 million received from Mexmar Offshore in 2021. It's a dynamic picture.
Okay, lastly, cash flows from financing activities. How have they been managing debt and equity from a cash perspective? Borrowing more, paying down debt.
Cash flows from financing activities have consistently shown a net use of cash in the 2019-2021 period, indicating they were primarily paying down debt rather than taking on significant new borrowings.
Using cash to reduce debt then.
Yes. They used $25.9 million in 2019, $22.6 million in 2020, and a much larger $78.9 million was used in financing activities in 2021.
Why so high in 2021?
That figure notably included scheduled debt principal payments of $78.1 million. It clearly reflects a strong commitment during that period to reducing their overall debt burden and strengthening their balance sheet using available cash, including proceeds from those asset sales.
Looking ahead, what did they estimate their future cash requirements would be, say, for 2023? Did their operating cash flow look sufficient to cover these needs?
For fiscal year 2023, they laid out their primary estimated cash requirements. Debt service was the big one, projected at approximately $85.9 million, covering both principal and interest payments due under their various loan agreements.
$86 million just for debt service. That's substantial compared to the $49 million operating cash flow.
It is. It highlights how crucial managing that debt load is. Other requirements included employee retirement benefit plans, around $1.3 million, and lease payments, around $3.5 million. Managing these outflows against their incoming operating cash flow and potentially needing cash from asset sales or refinancing is key to their ongoing financial stability.
So, a clear plan for cash deployment, but a tight equation. What about their overall liquidity position? If they needed cash quickly, beyond operations, what are their options? Selling more vessels.
That's one potential lever, selling vessels for liquidity. The company acknowledges they may seek to do this. However, they also caution it can be challenging, especially if the industry is in a downturn.
Harder to find buyers.
Exactly. Finding buyers with adequate financing can be difficult, and they might have to accept less favorable prices or terms than they'd like. Plus, as we discussed, the terms of their existing debt agreements might actually limit their ability to sell certain assets or dictate that proceeds must be used to pay down specific debt, constraining their flexibility.
So selling ships isn't always an easy fix. What were those construction reserve funds mentioned? Do they help with liquidity?
The Construction Reserve Funds, or CRFs. These are special accounts set up under agreements with MARAD, the U.S. Maritime Administration. They allow a company to defer paying taxes on gains from selling U.S.-flagged vessels if those proceeds are reinvested within a certain time frame, usually 3 years, with possible extensions, into building or acquiring new qualified U.S.-flagged vessels.
So it's about deferring taxes to encourage reinvestment in the U.S. fleet, not really about general liquidity.
Primarily, yes, it facilitates reinvestment. However, the filings noted that as of December 31st, 2021, the company had no balance in short-term construction reserve funds. This suggests they weren't holding significant deferred gains in these specific accounts, earmarked for immediate reinvestment at that particular point in time. 4. Strategic transactions and related party dynamics.
All right, that gives us a good handle on the balance sheet and cash flow picture. Let's shift gears now and look at some of SEACOR Marine's specific strategic transactions and also the dynamics with related parties. They've seemed quite active with acquisitions and divestitures, haven't they? Clearly navigating this changing energy world.
They certainly have been active. These transactions really paint a picture of their evolving strategy over the last few years. Take Windcat Workboats, for example, that business focused on CTVs for offshore wind.
Right, the one they sold.
Yes, but interestingly, before selling it, they actually consolidated ownership. In early 2019, they acquired the remaining minority interest they didn't own, achieving 100% control. They paid cash and issued some stock for that.
So they bought it all, then sold it.
Exactly. Just under 2 years later, in January 2021, they sold the entire Windcat Workboats business. As we discussed, it was classified as discontinued operations. It was a clear strategic pivot, divesting what they perhaps saw as a non-core asset, despite the general buzz around renewables, maybe to streamline operations or raise cash.
Interesting timing. What other notable acquisitions did they make, maybe to strengthen their core fleet?
Well, in 2019, they made an FSV acquisition. They acquired 3 fast supply vessels. Instead of cash, they paid by issuing a private placement of their common stock, valued at about $7.8 million at the time. And importantly, that deal also terminated a previous revenue-sharing pooling agreement they had for those specific vessels. So it brought those FSVs fully in-house under their direct control and earning potential.
Consolidating control again. Anything else similar?
Yes, in 2020, they did something similar with Falcon Global Holdings. They acquired the remaining 28% minority interest they didn't already own, again paying with shares of common stock to gain 100% ownership. These moves definitely show a drive to consolidate control over key operating subsidiaries and assets.
And what about the OSV Partners merger? That sounded like a significant consolidation move, too.
It was indeed a key transaction, happening in December 2021. OSV Partners was a joint venture that owned and operated 5 platform supply vessels, PSVs.
Which SEACOR Marine had an interest in but didn't fully own.
Correct. Through the merger, OSV Partners was absorbed into a wholly owned subsidiary of SEACOR Marine. As payment, the company issued over 1.5 million shares of its common stock to the other limited partners who had invested in OSV Partners the first.
So another move to bring important vessels under their full control.
Exactly. It consolidated those 5 PSVs fully under their umbrella, allowing for more unified operational management and capturing all the economics from those vessels.
And then came those complex-sounding framework agreement transactions in September 2022. What was going on there? Seemed like a lot of moving parts.
They were indeed multifaceted. It looks like a significant restructuring, primarily focused on their international joint venture portfolio.
Okay, break it down. What were the main pieces?
First, they sold off all their outstanding equity interests in a subsidiary called SEACOR Marine International. This subsidiary held their interests in joint ventures, Mexmar, Mexico, and OVH, presumably another international JV. They got $66 million in cash for this.
So, exiting those JVs.
Effectively, yes. The result was that SEACOR Marine no longer owned any direct interest in Mexmar or OVH, simplifying their global structure.
What else was part of that framework?
Second, they sold one of their AHTS vessels, the SEACOR Davis. But instead of cash, they received the remaining equity interest they didn't own in another entity, SEACOR Marlin LLC, making that one a wholly owned subsidiary. So an asset swap, essentially, to gain full control of SEACOR Marlin.
Okay. Anything else?
Third, they received a hybrid battery power system from OVH as repayment for a vessel loan agreement they had.
Interesting. So getting equipment back instead of cash on a loan.
Seems like it. Taken together, these framework transactions clearly represent a strategic simplification, exiting some complex JVs, consolidating control over another entity, and settling some intercompany debts, partly through acquiring specific assets like that battery system, optimizing the portfolio.
Definitely a lot of strategic shuffling. Now let's turn to related party dynamics and governance. They spun off from SEACOR Holdings a few years back, right? June 2017. Did that create any ongoing connections or obligations?
Yes. The spinoff on June 1st, 2017, made SEACOR Marine an independent public company. But, as is common in spinoffs, they entered into several agreements with their former parent, SEACOR Holdings, to manage the transition and ongoing relationship.
What kind of agreements?
Things like a distribution agreement, handling the mechanics of the spin, a transition services agreement, where SEACOR Holdings might provide certain services like IT or HR for a limited time, an employee matters agreement, and a tax matters agreement. These basically set the rules for how they'd operate independently, but also how they'd handle shared history, liabilities, and administrative functions post-spin.
And did SEACOR Holdings continue to provide any financial backing? Guarantees, maybe?
Yes, that's mentioned. SEACOR Holdings continued to guarantee various financial obligations of SEACOR Marine after the spinoff, likely helping the newly independent company secure credit on favorable terms.
Was that free help?
No, there was a cost. SEACOR Holdings charged SEACOR Marine a fee, specifically mentioned as 0.5% annually on the outstanding guaranteed amounts, which was $22.8 million back in 2019, for example. So it provided backing, but it came at a price, showing how that past relationship still had financial implications.
There was also a specific tax refund agreement between them in June 2020. That sounded interesting, related to NLs and the CARES Act.
Yes, that was a clever bit of financial maneuvering, taking advantage of tax law changes. Because SEACOR Marine had generated significant net operating losses, NLs, in 2018 and 2019, the CARES Act, passed in response to COVID, temporarily allowed companies to carry back such losses further than previously permitted, potentially generating refunds from taxes paid in earlier profitable years.
But those earlier years were pre-spin when they were part of SEACOR Holdings' consolidated tax return.
Exactly. So SEACOR Holdings, as the former parent, was the entity technically eligible to claim these refunds related to pre-spin taxes, even though the losses generated them belonged to SEACOR Marine's business post-spin.
How did they resolve that?
They entered into the tax refund agreement. SEACOR Holdings claimed the refunds totaling $32.3 million, including interest on behalf of SEACOR Marine. Under the agreement, SEACOR Holdings passed most of the cash back to SEACOR Marine, but retained some portion to offset its own tax attributes, and also received a $3.0 million transaction fee for facilitating it.
So SEACOR Marine got a significant cash infusion from past losses thanks to this agreement with its former parent.
Essentially, yes.
Yeah.
It was a way to unlock the cash value of those NOLs more quickly than they might have otherwise.
What about other significant related parties? The Carlyle investors were mentioned as holders of those convertible notes. What's their role or influence?
Carlyle investors are significant note holders, yes. And because of that stake, they have certain rights. They have the right to nominate one director to SEACOR Marine's board if their effective ownership, including potential shares from converting their notes and warrants, exceeds 10% of the outstanding common stock.
Have they exercised that right, put someone on the board?
As of the time of the filings reviewed, they had not yet exercised this nomination right. However, they do have observer rights, meaning they can attend board of directors meetings even without a formal vote. This indicates their ongoing significant interest and potential influence as a major investor and creditor.
It also seemed like some executives had personal investments linked to that OSV Partners joint venture that later merged into the company. Can you clarify that?
Yes, the filings disclosed that certain key individuals had personal financial interests involved there. This included Charles Fabricant, who was a former non-executive chairman, John Gellert, the current president, CEO, and director, and Jesus Yorca, the EVP and CFO.
How were they involved?
They apparently had personal investments in entities referred to as the Caroline entities, which in turn were investors or limited partners in OSV Partners, the very joint venture that SEACOR Marine later acquired via merger.
So executives had personal stakes in a company that their main company then acquired.
That appears to be the structure disclosed. It represents a layer of related party involvement in that specific strategic transaction, which is important for governance transparency.
Definitely something to note. Finally, let's touch on executive compensation plans. How are the top people incentivized? Is it aligned with creating shareholder value?
The company uses several common mechanisms to compensate and incentivize executives, aiming to align their interests with company performance. They have equity incentive plans, most recently the 2020 plan, which authorizes issuing a significant number of shares as awards.
What kind of awards? Stock options?
Yes, awards can include stock options, stock appreciation rights, SARs, restricted stock, and performance-based awards like performance restricted stock units, PRSUs.
How does the vesting work? Do they get the stock right away?
No, there are vesting periods. Restricted stock typically vests over 1 to 4 years. Stock options also generally vest over 1 to 4 years and usually expire after 10 years if not exercised. The PRSUs are interesting. They typically cliff vest, meaning they pay out all at once after a 3-year performance period if certain targets, often including stock price hurdles, are met.
So performance metrics are built in, especially for the PRSUs.
Correct. There are also conditions for accelerated vesting, like in the event of death, qualified retirement, or termination without cause, which is fairly standard.
Do regular employees get a chance to participate in ownership too?
Yes, they have an employee stock purchase plan, ESPP. This allows eligible employees to buy shares of common stock, usually through payroll deductions, at a discount to the market price, typically 85% of the lower price at the beginning or end of an offering period. It's designed to encourage broader employee ownership.
What happens if there's a financial restatement, if the books were wrong? Is there any mechanism to claw back executive bonuses?
Yes, and this is an important governance feature. They have a clawback policy. It explicitly states that compensation, particularly incentive-based compensation, like bonuses or equity awards tied to financial results, is subject to recovery by the company if the financial statements have to be restated due to material noncompliance with financial reporting requirements.
So executives might have to give money back if there was misconduct or a major error.
That's the intent. And importantly, the policy states the company will not indemnify officers against such losses. It underscores accountability for financial reporting integrity.
One last thing on executives, those Rule 10b5-1 trading plans. What are they?
Yes. Key executives, including the CEO, CFO, and Chief Accounting Officer, have adopted Rule 10b5-1 trading arrangements. These are pre-established plans that allow insiders to sell a predetermined number of their shares at a predetermined time or price schedule.
Why do they do that?
It's primarily designed to provide an affirmative defense against accusations of insider trading. By setting up the plan when they don't possess material non-public information, they can sell shares later, according to the plan's schedule, even if they subsequently become aware of inside information. The filing specified the number of shares covered and the end dates for these plans. CEO John Gellert's plan covered up to 67,848 shares by March 14, 2025. It provides transparency and legal protection for routine share sales by insiders. V, navigating the risk landscape.
Okay, we've covered a huge amount: operations, financials, strategy, governance. Now let's pivot to the challenges, navigating the risk landscape. Every company has risks, but for one like SEACOR Marine, so tied to global energy markets and geopolitics, the risks must be pretty significant and complex. What are the major external economic and market risks they call out?
You're right, the external risks are substantial and multifaceted. Top of the list, as we touched on, is hydrocarbon price fluctuations and the potential for demand reduction.
The oil and gas price volatility again.
Yes, their whole traditional service offering is incredibly sensitive to oil and gas prices, which drives customer spending. But it's not just the short-term price swings. There's the longer-term structural risk, too.
Meaning the shift away from fossil fuels.
Exactly. Factors like the massive increase in unconventional supply from shale, the continuing rise of alternative energy like solar and wind, plus ever-tightening environmental regulations, all these are expected to dampen long-term demand for hydrocarbons. So they face headwinds from both cyclical market volatility and the secular energy transition. It's a tough spot.
Balancing the present and the future. What else externally keeps them up at night? Geopolitics.
Geopolitical instability is huge for a global operator like them. Think about all the factors. Non-OPEC production decisions, international sanctions like on Iran or Russia, civil unrest, actual conflicts, Middle East, Ukraine, Venezuela are examples given, terrorism, just general global economic conditions.
All impacting energy markets.
Profoundly. They impact commodity prices, trade routes, customer investment confidence, operational security. Recent conflicts in Ukraine, Israel, and around the Red Sea are prime examples of how these events create unpredictable and often negative impacts on their business environment.
And the competitive environment must be fierce in the offshore support vessel industry.
It's described as intensely competitive. It's a highly fragmented industry, often suffering from an excess supply of equipment, especially during downturns.
Too many boats chasing too little work.
That's often the dynamic, yes, which puts enormous pressure on charter rates and utilization. Competition isn't just on price. It's based on service reputation, the quality and technical capabilities of the vessels, availability, safety record, efficiency, mobilization costs. Even national flag preference plays a role in some markets.
And has competition changed recently?
Yes, it's even intensified because many of their competitors have gone through bankruptcy or restructuring processes. This often allowed those competitors to shed significant amounts of debt, emerging leaner and potentially able to operate profitably at lower rates, making them even tougher competitors.
Right. A reset balance sheet can be a big advantage. What about the growing focus on climate change and ESG, environmental, social, and governance standards? How does that impact them as a risk?
This is a rapidly evolving and increasingly significant risk area. On the regulatory front, new laws and regulations are constantly being discussed or implemented globally. Things like MARPOL annexes tightening ship pollution rules, potential carbon taxes, cap and trade systems, stricter efficiency standards for vessels, restrictions on shipping emissions.
All potentially increasing costs.
Significantly increasing operating costs and potentially requiring expensive vessel modifications or investments in new technologies. Beyond direct regulation, there's the pressure from the investment community.
Investors focusing more on ESG.
Definitely. Institutional investors, in particular, are placing much greater emphasis on ESG performance. This could lead to reduced investment appetite or difficulty accessing financing for companies heavily involved in the hydrocarbon sector. Even those supporting it, like SEACOR Marine, they might find capital harder or more expensive to come by.
Have they responded to this ESG pressure?
They have. Recognizing this trend, the company formed the Sustainability Council back in 2020, specifically to oversee its ESG program and reporting. It shows they're aware and trying to proactively manage these evolving expectations.
Okay, that covers a lot of the big external pressures. What about operational risks, the challenges inherent in just running this kind of business day to day?
Well, we touched on seasonal operations earlier. That peak demand in summer is great when things go well. But any significant disruption during that key earning period, a bad hurricane season in the Gulf, severe weather in the North Sea, a major vessel incident could disproportionately harm their annual financial results. They're more vulnerable during those peak months.
And maintaining these large, complex vessels, construction, repairs, dry dockings, that must carry risks.
Absolutely. Vessel maintenance and construction is inherently risky. They constantly face the possibility of delays and cost overruns when building new vessels, converting existing ones, doing major repairs, or even just routine mandated dry dockings.
What causes delays or cost overruns?
All sorts of things. Shortages of specialized equipment or parts, broader supply chain disruptions, limited shipyard availability or capacity, shortages of skilled shipyard labor, unexpected engineering problems, work stoppages or labor disputes, bad weather disrupting schedules, general inflation pushing up material costs, and even difficulties obtaining the necessary regulatory certifications or class approvals afterwards.
So a lot can go wrong, and a vessel out of service is a vessel not earning revenue.
Precisely. Delays directly impact contract commitments and cash flow. Keeping the fleet operational and managing these maintenance cycles efficiently is a huge logistical and financial challenge.
Beyond the regular operations, what about specific contingencies and litigation? Are there any major legal headaches hanging over them?
There are a few significant ones disclosed. They've been dealing with a Brazil tax deficiency notice since 2015. It relates to disputes over profit participation taxes and Social Security contributions for certain vessel operations there.
How much exposure is that?
The potential levies mentioned were in the range of R$12.8 million to R$17.5 million, which translated to roughly USD $3.2 million to $4.3 million as of late 2019. The company is appealing, and while a subsequent Brazilian law might support their position, its application to these past administrative proceedings is uncertain. So it remains an unresolved potential liability.
Okay. And then sadly, there was that very public SEACOR Power incident in 2021, the lift boat capsizing. What's the current status and potential impact of that?
That was a tragic event with significant repercussions. The capsizing off the coast of Louisiana resulted in loss of life and garnered intense media and political scrutiny. Official investigations by the NTSB and the U.S. Coast Guard are still ongoing and were expected to take 2 years or potentially longer.
And the legal side? Lawsuits.
Yes, numerous civil lawsuits were filed against the company by family members of the deceased crew and by surviving crew members. In response, SEACOR Marine filed a Limitation of Liability Act complaint in federal court. This is a maritime law procedure that seeks to consolidate all claims into one proceeding and potentially limit the ship owner's total liability to the value of the vessel and its pending freight under certain circumstances.
So the final outcome is still very uncertain.
Highly uncertain. The amount and timing of potential costs, liabilities, fines, penalties, the impact on their reputation, and crucially, the impact on their future insurance coverage and costs all remain significant open questions and risks for the company.
That sounds incredibly complex and potentially very costly. Are there other general litigation risks?
Yes, like any large operator, they're involved in various other general litigation matters arising from their business, things like property damage claim, personal injury claims. Management makes estimates and sets up reserves for these, but they acknowledge that the actual outcomes could differ, creating ongoing financial uncertainty.
Okay, turning to regulatory compliance now. Especially with their global reach and U.S. operations, the Jones Act seems like a big one for them.
The Jones Act is absolutely critical for their U.S. operations. It's the U.S. cabotage law, which dictates requirements for vessels operating in U.S. coastwise trade, basically, transport between two U.S. points.
And the key requirement relates to ownership.
Yes. A core tenet is that vessels in Jones Act trade must be owned and operated by entities that are controlled by U.S. citizens. Specifically, non-U.S. citizens can own no more than 25% of the equity interest in these entities.
So SEACOR Marine has to carefully manage its foreign ownership levels.
They absolutely do. To ensure compliance, their own certificate of incorporation and bylaws actually impose a stricter limit, restricting non-U.S. citizen ownership of their common stock to 22.5%. They have procedures to monitor this.
What happens if they accidentally go over that limit?
Failure to comply could have severe consequences. It could lead to the suspension of their right to operate in the U.S. coastwise trade and potentially even the forfeiture of the vessels involved.
Yeah.
It's an existential risk for their U.S. business, so maintaining compliance is paramount.
Wow, okay. What about environmental laws? Operating offshore, they must face a lot of scrutiny there.
Immense scrutiny. They are subject to a vast web of environmental laws, federal, state, local, and international. Key examples include the U.S. Oil Pollution Act of 1990, OPA 90, which imposes strict liability for oil spills and requires detailed response plans. CERCLE, or Superfund, deals with hazardous substance cleanup. The Clean Air Act regulates emissions. The International Safety Management, ISM code, sets operational safety and pollution prevention standards globally.
And violations are costly.
Very. Violations can result in significant civil and criminal penalties, hefty fines, injunctions forcing them to stop certain operations, or even complete operational termination in severe cases. Compliance itself is costly, requiring investment in pollution control equipment, increased staffing for monitoring and reporting, and potentially significant changes to operational procedures. And the regulatory landscape only ever seems to get stricter.
And with their global footprint, what specific risks arise from operating in so many different foreign countries, beyond just the environmental rules, which might vary?
International operations risks add another layer of complexity. They face exposure to foreign government regulations that might explicitly favor local competitors or impose burdensome local content or employment requirements. There can be restrictions on transferring funds out of the country. Political instability, wars, civil disturbances, acts of piracy, and kidnapping of personnel are unfortunately real risks in some regions where they operate.
What about corruption risks?
That's a big one too. They have to be extremely vigilant about complying with anti-bribery laws, like the U.S. Foreign Corrupt Practices Act, FCPA, and the UK Bribery Act 2010. Operating in countries where bribery or facilitating payments might be considered more commonplace increases their risk. Even unauthorized actions by local employees or third-party agents could potentially expose the company to significant liabilities, fines, and severe reputational damage. Currency fluctuations are another constant risk affecting international earnings.
A minefield of potential issues. And of course, we can't ignore the risk of future health outbreaks like COVID-19.
Right. The COVID-19 pandemic clearly demonstrated how global health crises can impact their business.
Yeah.
It led to decreased demand for services as projects were delayed, increased operating costs due to testing, quarantines, and travel restrictions, and logistical nightmares getting crews to vessels.
And the risk remains.
Yes. While many restrictions have eased, the risk of future outbreaks or the reinstatement of restrictions remains. It could again curtail travel, impact vessel deliveries or mobilizations, affect crewing, or lead to broader economic downturns that hurt oil and gas prices and demand for their services. It's a background risk that hasn't entirely disappeared.
Finally, let's look at corporate and financial risks, things closer to the company's internal structure and finances. How dependent are they on their key leadership?
They explicitly state that their success depends significantly on their executive officers and other key management personnel. The loss of services from one or more of these key individuals could, they say, materially harm their business, financial position, results, cash flows, and future growth prospects.
Do they have insurance for that? Keyman insurance?
Interestingly, they note that they do not maintain Keyman life insurance on their executives. So that specific financial mitigation isn't in place, making the retention of key talent even more critical.
What about their internal controls over financial reporting? Sarbanes-Oxley Section 404 requires companies to vouch for their controls. Any issues there?
Maintaining effective internal controls over financial reporting is crucial for reliable reporting and investor confidence. They acknowledge that if they failed to maintain adequate controls, it could lead to delays in financial reporting, potential violations of stock exchange listing rules, breaches of debt covenants tied to timely reporting, and ultimately a negative impact on their stock price due to lost investor trust.
Has their auditor specifically tested the effectiveness of these controls?
This is an important point from their filings. Their independent auditor, Grant Thornton LLP, performed an audit of the consolidated financial statements, but they explicitly state that the auditor did not perform an audit of the effectiveness of the company's internal control over financial reporting. This is permissible for certain categories of filers, but it's something for investors to be aware of. There isn't that separate auditor attestation on control effectiveness.
Got it. Their debt structure also imposes limitations, right? Beyond just meeting the financial ratios, the debt agreements restrict what they can do.
Yes, absolutely. Those debt structure limitations go beyond just the covenants we discussed. The credit facilities impose various restrictions, negative covenants that limit their operating and financial flexibility.
Like what kind of restrictions?
They can limit their ability to incur additional debt, make certain types of investments or acquisitions, sell assets, pay dividends, which we know they don't intend to anyway, or merge with other companies. These restrictions are designed to protect the lenders, but they can constrain management's ability to pursue opportunities or respond quickly to changing market conditions.
And their hedging activities meant to reduce risk can sometimes backfire or create new risks. Seems odd.
It does seem counterintuitive, but yes, hedging activities carry their own risks. While they use hedges, like interest rate swaps or fuel hedges, to mitigate exposure to market fluctuations, the hedges themselves can result in losses. For example, if they lock in an interest rate with a swap and then rates fall sharply, they might end up paying more than the market rate. Or if fuel prices plummet after they've hedged, they miss out on the benefit of lower prices. There's also counterparty risk, the risk that the bank or institution on the other side of the hedge fails to perform. Hedging can also sometimes increase earnings volatility reported under accounting rules, even if the underlying economic risk is reduced.
So hedging isn't a perfect shield. What about their dividend policy? We know they don't pay one, but is that official policy?
Yes, it's very explicit. Their stated dividend policy is that they do not expect to pay any cash dividends to holders of their common stock in the foreseeable future.
And the reason?
They state that any future earnings, if they generate them, are intended to be retained for debt repayment and for the development and growth of their business. They explicitly say that capital appreciation of the stock is the only source of gain that investors should expect.
Yeah.
It's a clear signal that reinvestment and deleveraging are the priorities over returning cash directly to shareholders right now.
Okay. And are there any anti-takeover provisions baked into their corporate structure? Things that might make it harder for someone to acquire the company?
Yes, their certificate of incorporation and bylaws include several standard anti-takeover provisions. These can make it more difficult or time-consuming for an outside party to launch a hostile takeover attempt or make significant changes to the board of directors.
What kind of provisions?
Things like restrictions on how board vacancies can be filled, giving the board the ability to issue blank check preferred stock without shareholder approval, which could be used offensively, the absence of cumulative voting rights for shareholders in director elections, making it harder for minority shareholders to elect directors, and advance notice requirements for shareholders who want to submit proposals or nominate directors at meetings. These are pretty common defenses.
And finally, the risks of just, well, bad press and changing accounting rules. These seem almost unavoidable sometimes.
They are pervasive risks. Negative publicity, whether factually accurate or not, can significantly harm their reputation, damage employee morale, and force them to incur substantial legal and investigative costs. It can be a major distraction for management. And accounting standard changes are a constant reality. New rules and regulations from bodies like the FASB, Financial Accounting Standards Board, or the SEC can significantly impact how they report their financial results, potentially require costly changes to their systems and processes, and even influence how they conduct certain aspects of their business. They have to constantly monitor and adapt to these evolving standards. 6. Looking ahead. Shareholder considerations and a final thought.
Wow, okay. We have really covered a tremendous amount of ground today. We've gone from their diverse fleet, navigating both oil rigs and wind farms, through the ups and downs of their financial performance, the strategic ins and outs, and this whole complex web of risks they face. So wrapping this up, what should someone listening, maybe a current or prospective observer of the company, really consider as they look at SEACOR Marine, especially given that clear no dividend policy?
Well, given that reinvestment and debt repayment are the stated priorities, not direct cash returns, your focus for analysis should really be on the metrics that reflect their ability to achieve those goals.
Like what specifically?
You'd want to closely track things like their operating income trend. That turnaround we saw is key. Cash flow from operations is absolutely critical. Is the core business consistently generating cash? And then link that back to fleet utilization and the charter rates they're achieving. Those are the engine driving the cash needed for debt reduction and reinvestment. Watching revenue and cost trends remains important too, of course.
So focus on operational performance and cash generation, as that's what fuels the stated strategy.
Exactly. That's where the value creation, according to their plan, is supposed to come from right now.
And how do the executive incentives we discussed play into this for shareholders or observers? Is management clearly motivated to pursue this strategy?
Understanding how that executive compensation is structured helps provide context. Seeing that awards like PRSUs are tied to specific performance goals, often including stock price hurdles, suggests an intended alignment between management's financial incentives and the goal of long-term value creation, which in their case currently means improving profitability, managing debt, and ultimately, hopefully, boosting the stock price.
So the incentives seem designed to support the strategy.
That appears to be the design, yes. Though alignment in theory doesn't always guarantee outcomes in practice, it shows the framework the board has put in place to motivate management towards those goals.
It's certainly clear SEACOR Marine is a company operating in a really dynamic and challenging space. They're right at the intersection of traditional energy and the transition to renewables.
Absolutely. They've shown some resilience, especially with that operating income turnaround in 2023 and the improving cash flow.
But they're still carrying a significant debt load, face that constant market volatility, intense competition, and a complex web of geopolitical and regulatory risks, not least the Jones Act for their U.S. business.
Indeed. That strategic bet on supporting both oil and gas and offshore wind is fascinating. But the path forward is definitely not straightforward. They need continued strong execution, favorable market conditions, and careful navigation of all those risks we've discussed.
This financial analysis has certainly given us, and hopefully you listening, a much deeper understanding of SEACOR Marine's journey, its current position, and the challenges and opportunities ahead. Which leads us to a final thought to leave you with.
Okay.
As you consider this detailed financial analysis of SEACOR Marine, what implications do you draw not just for this one company, but more broadly for other companies trying to navigate this incredibly complex global energy transition, where traditional offshore expertise meets the evolving demands of green energy? How might this kind of balancing act shape their long-term value and prospects in what seems like an increasingly uncertain world?
That's a really provocative question. It really gets to the heart of how established industries adapt, doesn't it? How they leverage old strengths for new markets while managing the decline, or at least the transformation of their traditional base. SEACOR Marine is, in many ways, a fascinating test case for that adaptability.
A lot to think about there indeed. That's all the time we have for this financial analysis of SEACOR Marine Holdings Inc. We sincerely hope this exploration has provided you with valuable insights and context. Remember to do your own research.
And consult a professional.
Absolutely. Please join us next time on The Deep Dive for more in-depth exploration of the companies and issues shaping our world.